Hello, everybody, and welcome to a very, very special episode of Gold Rush here on Stock Market TV. We have our good friend, Mr. Josh Young, joining us today from Bison Interests. He is a portfolio manager, he's an analyst, he's one of the best guys to talk to about energy, and I don't think been a better time to talk about energy in the past, man, 3, 4 years than right here, right now, today, with this situation happening in Venezuela. Josh is going to school us on with what's happening there, and we were talking before we jumped on here about how Josh came to name everything he does after Bison. So, Josh, what is it with you and Bison? There must be a good story there.
Yeah, so actually, my co-founder for Bison Interests, my investment firm, he came up with it. And bison, they say, are the only four-legged animal that when there's a storm, the other animals they run away from it, and the bison they face into the storm and they get through it safer and faster. And so the idea was in 2015 when oil prices had collapsed in 2014 and everyone was running and all these public equity, oil and gas equity funds were closing. The thought was we're going to do the craziest thing and we're going to go open a public equity fund investing in public oil and gas stocks. And so we're going to face into the storm. The thought was that these things were going to rebound, which they did a little, but we thought that they would experience multiple expansion, and instead they experienced substantial multiple compression. So here we are a decade later, and down one business partner, and still investing in oil and gas public equities.
Well, it certainly worked out for you in 2020 and 2021. The last time you were on here, you told us you returned like what, over 500% over those few years there with an energy bull market. Um,
Yeah, so actually there's this I have some industry friends who I barbecue with and they got this thing made behind me that's it's sort of weird. I don't like having a picture of myself, but it's sort of the center of this thing. So it was a Barron's article where they talked about the fund in 2021. It was up 389%. Um, and that was gross, not net, but still, net of commissions and whatever, but gross of fees. And so from I think the bottom in November of 2020 to the top in June of 22, I think we were up like 1,200%, something like that. No one count on that, don't rely on it, but just directionally, it was absolutely wild.
that is insane. Do you hear that, everyone? This guy knows what he's doing. All right, Josh. So school us. What is the current situation today? What should we be doing with our money? Jason and I have been sharing this chart a lot. Talking about Jean Gauthier, if you will, throw up slide number 2. Talking about how gold kicks off these major commodity cycles. Then you get copper and the rest of the base and industrial metals start to work. And then, we came into the year thinking that, it's probably time to start looking at energy. It hasn't really done anything at all. And you have these metals ripping to new highs every single day. And then what do you know? Well, this whole Venezuela situation happens. So is it just serendipity? I mean, what's the situation here, Josh? Is it time for oil and energy stocks at large?
Well, it's one of those things. So first of all, like I'm generally not much of a technical analyst, although I do like to look at long historical price and value relationships. So less like the technical whatever thing on today versus yesterday chart, whatever. But looking at these sort of historical charts, I think is really informative and interesting. And I've shared your guys' work with citation and so on, publicly in newsletter articles and various other things. I think this particular chart is really fascinating. There's the strangest thing that starts to happen, like we're seeing right now, where at the start of bull markets, people are maximally pessimistic. They say that bull markets take the fewest possible people with them. And this isn't going to be, foreign to your listeners, but it's just when you think about what that means however negative you feel towards something, you want to sort of like invert that to how positive you should be about the equities or whatever, or the commodities. And so you have the strangest thing right now, which is actually really similar to what you saw in 2020, which was sort of a mini cycle for oil, and what you saw in the headlines in 2001 where they said end of oil and it showed like a computer stuck in the mud and oil and whatever and the similar stories also in the late 60s and that it's so weird where the narrative is there's a super glut for oil, right? And at the same time, you have America invading Venezuela, stealing their dictator for oil. And so pick one, right? Either there's a super glut and oil doesn't matter and the price is going to fall, like Trump is saying oil is going to 50, or there's a real problem and we're about to see that more than a decade of underinvestment is going to lead to much higher prices, like we saw for gold, like we saw for copper, and now we're starting to see, I think, for oil. And again, we're not really seeing it in the price yet, but I think we can see it in the fundamentals. And one of the other things that's so interesting about this, and I just started to do some work on it. We haven't done sort of a full study, but AI is sort of fun. You can throw stuff into various AIs and have them like sort of start doing your research analyst stuff for you. And if you look at the past cycle demand for oil, I think we talked about this a little bit, but I hadn't done the analysis, or at least had the AI do the analysis yet in our last conversation a number of months ago. In the last bull market for precious metals and base metals, there was almost 1 million barrels a day of incremental oil demand just for mining activity. And so if you look at current mines and the current status of the mining industry, which is calamitous. I mean, the stocks are up, but all these companies are producing less and the ore grades are lower and whatever. I think it's reasonable to expect that you'd get 2 or 3 times as much oil demand per equivalent to, let's say, the last cycle in the early 2000s. And it actually sort of tracks if you look at how much oil was used in the 70s for that mining boom. I think it was something like 600,000 barrels a day, something like that. And then 1 million barrels a day or so directionally in the early 2000s in that mining boom. And so I think we're going to get to sort of towards this peak. Maybe it's two, maybe it's three, maybe it's 1.5. I don't know, but somewhere in there, incremental oil demand for extractive activities. And so that's why you look at this and people say, oh, technical analysis, price studies, whatever. You look at it and say, no, no, no. This is telling you there's going to be a ton of oil burned for this. And also the other sort of background factors that would push gold up and push copper up. So anyway, that's I think the way to frame it. So what's specifically going on in Venezuela? What exactly is going to happen there? Honestly, I don't know. And anyone that tells you that they know also doesn't know. And frankly, I don't think Trump knew, and the industry executives definitely didn't know. They admitted it before saying, "Oh no, no, we knew." It was like what was it when we bombed Iran in June of last year, and at first everyone said, "Oh no, we didn't take out their nuclear capabilities," and then the Trump administration went around and twisted everyone's arms, and then magically the same people a week later, 2 weeks later, "Oh yeah, definitely, he destroyed everything, best president ever." So I think similar sort of dynamic right now playing out. And again, don't mean to make this political. It's not really about the politics for me. It's more about just understanding what's actually happening. And I think the important part, the message I'd have is, look, there's a lot of noise and a lot of big claims, and basically like no one knows anything. And the cone of uncertainty is really big on this. But what isn't big is, from a cone of uncertainty perspective, is this trend. And did it start 2 months ago, a year ago? Is it going to start 3 months from now? I don't know exactly. I just know this is extremely likely. And the longer it takes, the bigger it's going to get. And it's the same drivers as the things that were driving the price movements for these other commodities.
I really like that, Josh. And, I always like to just assume that I know nothing and just listen to what the market is saying. And so far, like for me, it's energy services have been by far the biggest beneficiary of this situation with Venezuela. I mean, I have an equally weighted basket of a handful of these energy equipment and services, and it's breaking out to the highest level since before COVID. And if you look at something like OIH, I think that's the VanEck Oil Services ETF, it doesn't look quite this good, but still very, very constructive. So, do you have any insight onto why the market is favoring these names over all the others?
Yeah, so when I look at this, one of the charts that I would put together years before I think we all met is the just sort of the long run performance for various energy ETFs versus the price of oil, and then, versus the long run price of, let's say, natural gas or whatever, and then also versus the broader stock market. And so the two subsectors among energy ETFs that really stood out for their poor performance over the decades subsequent to the crash in 2014 were OIH, which is the Oilfield Services Index, and PSCE, which is sort of the small cap producers and services index. And so the large cap XLE had actually done okay, not nearly as well as the overall market, but it had done okay. XOP, which is a little smaller, but still sort of the large producers and large services companies, but not the Exxons and not really like all Schlumberger and Halliburton like OIH. That had done a little better. But then, I mean, you look at the performance, they were sort of like tagging each other, the small cap producers and exploration companies and the services, even the big services, they were down 70% or so from their highs in 2014. And so I don't think it should be a surprise that oilfield services or the small caps would perform particularly well. And if you look back at those past cycles that we were looking at on that last chart, and you look at sort of where those as positive inflections, everyone says, oh, you need to own the big companies because they move first or whatever. There's some narrative around that that maybe is sometimes true. But if you look at who actually moved first in those last cycles, it was the services and the small caps, the ones that had done the worst in the prior cycle. They do terrible in down cycles. And frankly, I'm guilty of hanging on to these things through that peak in 2022. So I did very poorly over a few year period through holding stuff. I did better, I guess, than those indexes, but not by much. I think these are where you want to be. And the reason I wanted to own them was I looked at the longer term and said, okay, like, I will take this short-term volatility. I'll be the bison. I'll face into this. I know it's going to be volatile, but it's going to be two-way volatile. And eventually you're going to see stuff like this do way better. That's all price-wise. Fundamentally, it's worth spending just a minute on the fundamentals for oilfield services. So one of the other things that had me super bullish oil still, and these producers and services companies, even in 22, when prices were higher and people said, hey, get out, is that there had been this multi-year underinvestment, not just in exploration and delineation of oil fields, but also in the oil field services themselves. So the number of drilling rigs that were built collapsed, the number of offshore drill ships collapsed, the service boats and supply boats collapsed. The whole sort of supply chain for developing new oil fields really, really consolidated. So there's fewer participants and there was massive underinvestment versus the prior period. So it's not just that they didn't drill enough wells to find new fields, it's that they didn't reinvest in their rigs and pressure pumping and all this other stuff. So the base for these companies, the capital base has been really, really reduced. So what you're seeing is you'll see these sort of multiple legs, I think, over this bull market, I think that's coming for oilfield services. We're going to see some combination of them getting pricing from terrible levels that are, not break even, but like pretty bad versus historical levels to good levels where they have great margins that induce them to go invest in new equipment. And people will get scared because they say, oh, new equipment's getting bought. That's not the end. That's just sort of that first wave. And then you'll see some absorption of the new equipment and then a next leg. And then typically it's sort of three or four, sometimes two legs for that sort of re-rating over. You look at that like 2000 to 2014 period, or you look at the 1968 or so, 1969, depending on when you start it, to let's say 1986 or somewhere for that like prior upcycle. So anyway, so there's massive underinvestment in these businesses. These businesses are going to go from under earning on their equipment and on their capital base and on their people and everything to over earning. And so you're going to see just real big inflections, I think, in the financial metrics for these businesses where the revenue is going to rise and the top line is going to rise potentially much more than the revenue. And then you'll see a capital cycle, which may get rewarded or punished. I'm not sure, TBD in terms of how the market interprets that, and then a next leg higher likely. So that's sort of the underlying of what's happening here. And again, like you look at this chart, I don't know really what this chart tells me from a fundamental perspective. I just see, hey, it shouldn't be surprising that if we're going into a bull market for these things, for energy generally, that oilfield services, along with the small caps, would be the ones that are starting to poke their heads up and saying, hey, this thing is going to do, hey, this is like weirdly resilient despite terrible headlines and low prices and all this other stuff.
Josh, do you think, just something I was thinking about the other day when the Venezuela news came out, and basically this year, as you know, like Donald Trump can come out and say gasoline's going to be under $2 or whatever, and it would just smack the oil price. And then the Venezuela news comes out, and oil was actually up when the futures opened, it was about flat, and then in the morning it was up the next day on Monday. Do you think that's kind of a strange occurrence, or do you think the market's pricing something else in? Because you might be seeing this from a more fundamental angle than me. Most of the time, when I'm looking at things, I'm looking at we have this very bearish piece of news, which I don't think it would have been long term, but I think short term we could have opened at a 4% down day for oil. However, then it opens up, or sorry, the next day's up. That kind of tells me something about the market. A lot of people either being mispositioned, too short in that entire market, which Sam and I have highlighted a bunch of times. If you're looking at any of these sectors in energy, the subsectors of energy, everybody's short these things. And so, do you think that was kind of an odd occurrence, or are you seeing something different where there was a fundamental bearish or bullish reason for the price to start moving up in oil around that time? And not to mention the energy stocks are looking really good this week as well.
So I don't know if you remember in June of last year, as we were all getting worried about the Strait of Hormuz getting closed because Israel was at war with Iran for 12 days. And there were some news items that were threatening that, and Polymarket was starting to show higher odds. And then I think it was Andrew Tate that put out a video about how everyone needed to go long oil, and it was terrifying. And frankly, I didn't pay enough attention. And I should have just bought a whole bunch of puts just right then, just as a
Wow.
trade and everything.
What a
That was like
contrarian signal
the
that is.
peak.
Wow.
It was the peak. So this weekend we had the equivalent of that. I don't know if it was quite that bad, but we had like Grant Cardone, you had the Kobisi letter. I don't know who they are, but they have like a zillion followers, whatever. You had all these people that know absolutely nothing about this who were convinced that oil prices were going to collapse because Maduro was removed. But there's
Mm.
a lot of stuff between Maduro being removed, especially in the way he was, where there wasn't real regime change, it wasn't whatever, and there actually being a lot more oil on the market. And so you
Yes.
saw like oil specialists being like, hey, wait a second, like, yeah, there'll be more oil in like 5 years, plus or minus
Yeah.
two. Um, and then you had these folks that are just run at whatever the bright flame is that were, saying, oh, price is going to collapse. So I think that was probably a good signal that prices would probably rise. I mean, the fundamental reason for it to rise would be elevated geopolitical risk, right? Elevated risk of further supply disruption through destabilization, especially in the context of there being almost no incremental supply. Like the only thing that really changed is a few 100,000 barrels a day that was sanctioned and was being held off the market now coming on. 300,000 barrels a day versus a 1.6 million barrel a day market. I mean, it's just not, we're talking about like a fraction, like 0.25% of the, it's just not meaningful, not enough to really move the price materially, and definitely not enough to offset that risk. So you saw prices up and then down, up the first day, down the second day, up the third day. Who knows what happens next? I don't know the short term, whatever, but this shouldn't be on balance much higher instability should outweigh probably a very small amount of incremental supply.
No, I totally get that. I think that's where I'm at on it as well, which is I didn't think either way. Like, yes, the news could have drove the price down in the short term. In the long term, I figured it'd be back up. But usually, when you see bottoms happen, go back to 2022 in October. You kind of saw the bottom happen when that nasty CPI report came out, and basically, that should have been the death of the market at that point all year long. Every bad CPI report that came out, the market would go down. Next thing you know, the thing just bottoms out right there. And that was the bottom basically to today. So I kind of see the same type of scenario where the sentiment just got so bad around oil and energy. And it just kind of continued that way. And everybody's short and everybody hates it. And it has been a frustrating trade. However, now we kind of have this news failure style event, which kind of tends to put in bottoms from time to time. And then, not to mention, energy is looking really good, keeps hitting the top end of the range. Sam, pull up that chart with the 52-week high. Yep, number 5. Yeah, so we're looking at the new 52-week highs are right there. For me, I'm looking for a weekly close. That's the way my models work. A weekly close above that level would be a confirmation of a new uptrend. and really, getting up and over those 2016 highs, which we haven't seen in a long time, would be more confirmation. But I want to ask you, like, outside of XLE, what areas are you looking at? I know you like to keep stuff for your subscribers so you don't have to give away any stocks, but what areas are you looking at? Like
Well, we
Sam,
have an interesting question here in the chat from
bring it up.
the doublet says, how many world refineries can even take the heavy oil from Venezuela?
Oh, good question. Good
Like,
question.
yeah, who do you see as the biggest beneficiaries in terms of equities, Josh? Like we talked about the services, and it kind of seems like that's not super tied to Venezuela. Maybe it is. Correct me if I'm wrong, but do you see the refineries potentially as the largest beneficiaries of this situation?
So yeah, so I think it's something like 4 or 5 countries that have refineries that can process the sort of ultra heavy crude that comes out from Venezuela. And I saw that somewhere. Don't rely on it. Maybe it's 6. I get told this all the time. I should give a directional answer. It's like, oh no, that's precisely wrong by like some tiny whatever. But not many countries have refiners that can process this oil. The incremental oil is coming to the U.S. to be refined in refineries that were built to process Venezuelan oil. So this should not be a shocker. It's incrementally positive for them, although I imagine there'll be some bidding for the oil, so it should just clear at the market price. And, you know, I don't think it really matters that much. I have some friends who are extremely bullish refiners. I'm actually not that bullish. I think there's like interesting situations and interesting ways to get exposure there. But I think it's easy to miss the global supply of refining, as well as the changing mix both of oil production and oil consumption, where a lot of that sounds esoteric, but basically you produce a bunch more natural gas liquids, so like ethane, propane, butane, whatever. And so the ethane and propane you get to use for chemicals. And so because you produce that directly from wells in West Texas and Southeast New Mexico and various other places, you don't put that into a refinery. You just send that directly to a chemicals plant. And so you're sort of skipping the refinery step for an increasing portion of the total global supply of oil similar liquids. And so when you look at that effect, along with just there being plenty of international refineries that are coming online and some that are at very low utilization due to sort of specific local price factors, it looks like there's plenty of refineries for right now. And so I'm not that excited about refineries. One, the stocks are actually up a lot. And then two, just when you do the actual math, it's just not that exciting. And it's weird to me because I see these folks deploying huge amounts of capital and the portfolio managers talking about this bull market for refining and maybe the stocks are up or whatever, but I don't see there being a there, if that makes sense. It's not that there's no profits there. It's not structurally undersupplied. And there's a really nice development pathway for a number of different international refineries in some countries where they produce and in other countries where they consume. And, it just makes a lot of sense that there would be vertical integration to the extent that they can get these things built cost effectively or whatever. So I'm not that excited about them. Maybe certain Gulf Coast refineries make a little more money because the heavy oil that they were built for is getting delivered to them again. So maybe that's good. It's just not where I'm focused. Like I was saying before, I think the small caps and the services are really where it's at. I think there's just so much more operating and financial leverage for those sorts of companies. And then there's also this lagged underinvestment that people still really aren't talking about much. They'll talk about it for the offshore drill ships, which have their own whole like weird dynamic. But if you exclude the offshore drill ships and the offshore supply boats, people basically never talk about underinvestment in oil field services and rigs. And so I think there's really a lot of upside on services, and then also on small caps, just the valuations are really low. You get all this weird pushback. Oh, like it's illiquid and therefore bad. And it's like, well, wait a second. Like these stocks were also illiquid in 2001, and if you look at how the small cap oil stocks did versus the large cap oil stocks, I mean, it wasn't even the same. You could buy Exxon and double, or you could buy XYZ small cap and get a 10x or 20x or 50x, and so or a zero, right? So there's a lot more risk, but there's also way more upside potential.
I wanted to ask you about that, Josh. I saw you shared this chart yesterday of the energy sector as a percentage of the S&P 500. And, there are very few times in history where energy has been this irrelevant. Like no index investor has exposure to energy. They have like 2, 3% exposure to energy. Like it could not be less relevant. So do you think that is a major potential bullish catalyst for energy? Like uh, it seems to me like it is. Nobody owns it. Like how much worse could it get?
Great question.
Yeah. Yeah, I think it's a great observation, great question. So when we launched Bison in 2015, the thought was we were going to go to endowments and family offices and just have it be sort of pure institutional. And the thought was, hey, we can beat the snot out of these passive indexes. We can just absolutely destroy them. There's going to be a bunch of bankruptcies. There's going to be a bunch of issues. There's governance issues. We'll go active on companies. We'll do whatever we need to do to be able to earn excess returns relative to this. We chose to focus on small caps. So the relevant benchmarks were either PSCE, the small cap ETF, or the Russell Microcap Index, sort of depending on who we were talking to. And there was this weird response that we got from allocators. Basically, there was the chief investment officer, David Swenson for Yale, had written this book about how endowments should allocate, and a bunch of family offices were copying this. Even the one I had worked for many, many years ago, they sort of had an endowment model allocation style. And so their thought was, we're going to pay a lot of money to private equity to do sort of private deals, and we're going to just allocate to passive indexes at low cost in order to sort of get our exposure. And so they saw even then, I think the sector exposure for energy was like 7%. And so they just put a bunch of money into, let's say, XOP or PSE, depending on sort of how bullish or bearish they were on the sector. But to get up to that sort of closer to, 10 or 12%, which is the earnings of the energy sector versus, let's say 7% at the time. And so we did really well relative to that. And this isn't a solicitation or whatever, just sort of that's like the end of the story is that you could actually really outperform versus these indexes by picking individual stocks and being careful with them and so on. And I think it's a similar dynamic here, maybe more extreme, because there were something like 100 or 50 or something public equity funds, doing public oil and gas stocks when we launched Bison in 2015. Now there's maybe 5 or 3 or I don't know, something that focus on that. So
That's
it's
crazy, Josh,
really
what you just said there. I mean, sentiment could not get worse for energy.
there were 200 when I started doing this professionally in 2007 for that family office. There were hundreds. There were, it was like the big thing to do to have a sector fund. You have a tech sector fund, maybe because tech hadn't done that well for a long time. And then you definitely had an oil and gas specialist at your fund. And maybe you also had a oil and gas fund. And so now there's like just that does not exist pretty much at all. And that's a lot of outperformance, I think, over time is from that. But you also risk multi-year underperformance because there's no one else. So like
Yep.
there's no there for a while until there's, a buyout or big dividends or buybacks or some other sort of big return driver, especially as you get to the smallest side of things. But the point of sharing that is I think so things got way more extreme. And to your point, yeah, I think it's just completely blown out, totally out of place relative to the likely future prospects in my assessment of the industry and these companies. And I think you have maybe a double or triple available in some of these largest caps, if that. And that will help sort of drag that XLE up. But I actually think what you're going to see is most of the contribution in my expectation for XLE, which I don't own, no position in it, whatever. I think it's going to be actually, it's 50% Exxon and Chevron and 50% or so, last I checked, a bunch of other smaller companies. And I think the smallest of those companies are contribute the most to the performance for that ETF over this next, let's say, decade. And I think where you'll see just massive outperformance is going to be on the small caps. And weirdly, for this cycle, I think services are even better positioned now than they were at the starts of prior oil and gas bull markets, just because of various dynamics of ESG and also just this downturn was just so vicious. And I mean, I don't know, get into that at length, but basically it's really, really nicely set up. And maybe also for OIH, you'll see the Schlumbergers of the world or whatever contributing very little and some of the smaller names contributing a lot more to the performance for that one in this next bull market. But I think that's sort of the driver. And so I think it's great for me, because there's a lot of really interesting individual stocks to pick and find that could potentially way outperform, like I've been able to in the last decade, which is, of course, is no assurance I'll be able to in the future. But there's a lot of really interesting situations. And my bet is that as you get into those sort of larger ETFs, there's probably in larger indexes and larger caps, there's still a bunch of really interesting opportunities to outperform. And that will, I think, contribute to that performance into this next cycle.
Josh, you are such a wealth of knowledge. Thank you for everything you've shared with us today. We have a busy day on the Stock Market TV channel, so we need to get out of here. But before we leave, we've discussed a lot today. I want to know one thing that we did not discuss today that has your attention and where our viewers can learn more about you.
Yeah, so I've been looking a lot at natural gas recently, and I think the last time we spoke, I was extremely bullish, and wow, did that pay out? I think it might have been at like 3 and it went to 5 or 5.20 or something. Great. I'm a lot less bullish on natural gas right here. If we don't see winter get way colder and sort of the overall forecast for the remainder of winter consume a lot more heating demand and a lot more natural gas, I think we're going to exit the season at a pretty tough spot, and so I think longer term natural gas should do great, but 2026 could actually be pretty tough. And I think people are way off sides on this, where they piled into these large caps and sort of very speculative, high valuation producers. Again, the excuse being, oh, it's liquid, it's whatever, I don't have to think about it, or it's a big part of the index or whatever. And I think those guys are actually at a significant amount of risk. The valuations are high. Fundamentals get real dicey if prices fall more from here. And I think there's a decent chance, no certainty, but there's a decent chance that prices disappoint at the same time as there's building consensus bullish gas, where a lot of people, should actually be bullish, I think, oil here. So that's something we didn't talk about. And I think people should be cautious of, and we'll be putting out stuff at Bison Insights or whatever to go through some more analysis on that. So yeah, it's great to see you guys. My firm's website is bisoninterest.com. I put out this newsletter like we talked about, I think last time I was on, called Bison Insights at bisoninsights.info. And I've shared individual stock ideas there as well as some market analysis. And I even shared a couple of your guys' charts a few weeks ago and made
I
sure
did
to
see
cite them
that.
and point everyone your direction.
Yeah. Thank you so much for coming on with hanging out with us, Josh. It was a blast having you on here as always. We'll have you back again soon, I'm sure. Always good stuff to talk about. We really appreciate you, man. Thank you.
Thank you so much.
Thank you, Josh.